Welcome to Next in Tech, an S&P Global Market Intelligence podcast where the world of emerging tech lives. I'm your host, Eric Hanselman, Chief Analyst for Industry and Company Data at S&P Global Market Intelligence. And today, we're going to be discussing the latest in FinTech and a lot of what's taking place in financial technologies. And to discuss it with me today, I've got Sampath Sharma and Jordan McKee. Welcome back to the podcast to you both.
Hey, Eric. Great to be back on the podcast.
Thanks, Eric. Great to be here.
Well, and great to have you. There has been a lot going on in FinTech, a lot of activities in a bunch of different areas. I guess maybe start off with a focus on what's happening in the very lively area of the startup world and sort of what's happening with funding. Sampath, what are you seeing and what's your research been covering?
Yeah, so that's definitely a great topic to talk about. Because, everybody in the fintech industry has been talking about, the industry seeing the so-called fintech, funding winter since perhaps the ending of the second quarter of 2022. We can probably say that the funding winter might finally be thawing, right? Because the second quarter of 2025, we saw surprisingly strong funding trends. In fact, that's the first time we have seen funding cross the $10 billion mark since the downturn. So yes, there is life in this sector yet. And now, here is the interesting thing. While the rebound, is very obvious in terms of value, in terms of deal counts, we're still seeing some kind of pressure. The fintech activity is still seeing some kind of pressure in terms of deal counts. That said, what we are now seeing is something more mature. Capital is kind of flowing, but it's highly concentrated. Investors are being selective. They're chasing quality and not necessarily quantity. And you can actually see that in the size of deals. Average deal sizes are now at a 2-year high, and mega rounds, meaning funding rounds that are either $100 million or upwards or in the north of $100 million. So they're back in a big way. So we had like about 23 mega funding rounds in the second quarter alone, which is actually the highest in the past 2 years. Now that tells us that the both growth stage and mature fintechs are definitely regaining investor confidence, especially the ones which are showing a path to profitability or proven business models. There are also many other trends that we're seeing here. So there is a clear shift in where the money is going. Risk heavy models like lending, like digital lending, are harder sell right now. Instead, we are actually seeing venture capital rotating to more capital efficient, infrastructure heavy business models. So think payment rails, data platforms, insurance tech, cross-border payments in particular are really hot, thanks to the ongoing demand to fix the mess that is global money movement. And regionally, the momentum is very much the US led. North America is pulling ahead, helped by stronger exit signals. The IPO market is back in a big way. So there have been at least 2 or 3 big IPOs that have come out and seen strong reception. So and historically, US has been a bellwether market for us. What happens in the US will inevitably find a way to set the tone for the rest of the world. So if this continues, we could well see a ripple effect that will sort of lift the other regions too. So overall, I would say fintech funding is back, and it's not like it's not back like it was in the go-go days, but it's more focused, more disciplined, and more mature.
So the green shoots of spring are starting to emerge, but only, I guess, in a few varieties right now. But to your point, the fact that deal activity is still pretty selective. There's still some focus on quality. Still early days, it sounds like, but some positive signs in terms of directionality.
Sampath mentioned the go-go days of fintech funding, which I think is the perfect way to put it, because from a funding perspective, we've been on a journey in fintech. And if you look back to 2021 and really the first half of 2022, we saw just a tremendous amount of capital injected into the sector. In 2021, almost $250 million per day was getting pumped into the fintech ecosystem. And because of that, we saw the fintech sector really sort of evolve in a way that wasn't sustainable. The model at that time was grow revenue as fast as possible. Top line revenue growth was the objective, the metric for any fintech. Aggressive hiring, really hiring for future growth. And that model, of course, was supported by easy access to capital. And many fintechs at that time were sort of built on this premise that access to capital would be cheap and plentiful. And as a result of that, you saw very high burn rates. And so when we hear people kind of refer to that time as the golden era of fintech, yeah, I would generally disagree. My take is that period is a period where the market got very bloated. We saw lots of fintech tourists on both the investor and the vendor side that were fast and loose with capital, with their strategy, come into the sector. And what we've seen in the past few years is more of a cleansing fire. We've come back down to earth. We're now in a healthier, more focused, more pragmatic fintech environment. And I think many of the fintechs that are still around today have really earned that staying power through better business fundamentals and really sort of orienting their strategy around long-term sustainable growth.
Well, and I just want our listeners to pause for a minute, because you moved through that pretty rapidly of the numbers from the go-go days of $250 million per day of investment flows. That, when we talk about party atmosphere, it doesn't get much more party than that.
It's exactly right. And, as a result of that, we saw so many fintechs just built on unsustainable fundamentals. It was all about growth. There really wasn't a long-term mentality in terms of building a business that had staying power. It was about how do we inch up the top line quarter after quarter as fast as possible. And inevitably, we saw the bottom fall out as the capital market shifted and fintechs couldn't get that capital to continue to fuel that growth that they were experiencing. We saw a lot of companies unfortunately fall by the wayside. And again, I think those that are around today have really been battle tested and are orienting themselves in a much more positive way in terms of how they grow the business.
Well, I think one of the phrases that I'm fond of is, I think I'll credit Brennan Daly with quoting out of the podcast a bunch, which is, hey, when somebody takes away the punch bowl, we'll see how well the party goes after that. Because suddenly, money costs something. Who knew, right?
That's exactly right.
Well, so I guess we've entered this era of, I guess, a bit more rational growth. It sounds like what you're both identifying is that there's a lot of opportunity here, and in the right areas. I guess, where do you see that developing, and what are some of those, I guess, the new relationships that fintechs are forging, and how do they actually really start to establish value in this more, I guess, mature, more rational stage of where this industry is headed?
Yeah, I think, Eric, it's important to first call out that there's really two sides of the fintech ecosystem. The consumer-oriented B2C players, and you can think of companies like maybe Robinhood or Chime or Klarna. These are the ones that capture most of the headlines. This is where a lot of the media focus is at the moment, and this is certainly a meaningful part of the fintech market. They continue to raise the bar for traditional financial institutions in terms of the digital experience that they provide. But it's also important to call out that on the other side of the coin, there is a very vibrant landscape of B2B focused fintechs that are laser focused on helping financial institutions modernize and plug into various types of emerging use cases. And actually, when we look at some of the funding data from last quarter, quite a bit of the activity, at least from my vantage point, was happening within the B2B side of fintech. You see Plaid raising something like $575 million in Q2, Ramp raising $200 million in the same time horizon. And so a lot of that energy feels like it's happening within the B2B ecosystem. And as a lot of Sampath's research details, many of these players are really setting themselves up to help financial institutions modernize and reinvigorate their infrastructure to actually go head to head with some of those consumer-oriented fintechs that are challenging them across many different fronts within their business.
Yeah, well, McKee Woolridge was on a few episodes ago talking about some of the opportunities, but also talking about some of the challenges. And I guess in terms of the B2B side of things, there's a lot that certainly can be done in modernizing those environments and also reducing friction for those back-end banks that are actually managing those capabilities.
That's right. And what we've seen is just a crop of startups emerge that are focused on helping financial institutions plug into instant payment rails, which we really see as one of the key inflection points for financial institutions, at least here in the US market, to modernize and really create that impetus for change and digital transformation. And Sampath, I know quite a bit of your research agenda is dedicated towards instant payments and instant payment enablers. We'd love some of your perspective on what you're seeing within that sector in terms of how these players are helping the traditional entities evolve their businesses to stay more competitive.
Yeah. So just to give a historical context to the enormity of challenges banks face when it comes to implementing instant payments. Well, we know that the banking systems that we continue to use were actually built way back in 1980s, right? So this was a time when banking, much of the banking was branch driven, and banking was all about people having to walk into a branch to open a bank account or to perform a transaction, so or to conduct a wire transaction, for example. And so therefore, back in the day, those systems were actually designed to support only batch based payments, meaning that banks, what they do is, end of the day, they collect all the instructions initiated by users, be they individuals or businesses, batch them together, and then move them to the network so that the transactions are cleared and the actual settlement happens 2 or 3 days later. So from then we've come a long way, and now we're talking of instant payments where the transactions cannot wait until the end of the day. Transactions, you cannot say that the transactions can only happen during business hours. The transactions must happen on the clock, right? And therefore, the core banking technology, right, which is essentially the system of record, must be compatible, must support the payment, occurring instantly, in real time. Now, to for that to happen, of course, most of the banks hoping to integrate or hoping to connect to instant payment networks on the current legacy systems, or staring at massive technical challenges, and they cannot hope to or aspire to undertake this challenge unless they turn to the cohort of technology players that Jordan was referring to, right? So meaning that the bulk of the majority of banks must rely on what we call as third-party enablers in real-time payments, right, to sort of activate these instant payments. And our research does show that there is within this cohort, there are like a number of players that are like positioning themselves in a big way, right? So if you look at the code providers, the likes of Pfizer, Jack Henry, FIS, so they continue to power the lion's share of US banks, and they remain very important in terms of doing the heavy lifting, actually migrating the majority of banks to instant payments. The core systems of old, like the COBOL on mainframe old, right? So they're not really exact support always on real-time settlement. So therefore, we are seeing a big rise in modular cloud-native platforms that sit alongside these legacy cores. So, and all these platforms, the payments as a service platforms or cloud-based alternatives, what they're essentially doing is they're sort of decoupling the payments engine from the core system, acting as orchestration layers that connect to various instant payment rails and even cross-border rails for that matter. And they're handling the processing logic, fraud checks, API integrations, and things like that. So depending on the bank strategy, there is flexibility in how this is done. Some go for full stack providers that offer everything. Others unbundle it, and So it's interesting how this is playing out. But overall, I would say the right vendor doesn't just provide plumbing, but they also provide a platform for competitive advantage.
This really winds up being a situation where you're fundamentally changing the cadence of bank operations, going from sort of that batching overnight kind of process to moving towards continuous operations. But that's a pretty radical change. And we think about the way in which processes, procedures, let alone all the tech that's behind this has been built. That's a big shift. And as you're pointing out, it's one that, depending upon the institution, it's going to need to take this in a number of different paths in terms of how they can adopt it. And you look at other regulatory imperatives. I'm assuming that open banking also starts to have a hand in pushing some of this technology transition. Financial institutions seem to be in the midst of a lot of flux in terms of their overall operating methodologies.
It was interesting, Eric. I was looking at some of our Voice of the Enterprise digital pulse data, and I did a cut within that survey looking specifically at financial services respondents. And the number one IT concern for financial services companies is the business risk associated with modernizing mission-critical legacy applications. And I believe that was like 13 points higher than any other industry within that survey. And so what we're seeing, as Sampath sort of alluded to, is a realization amongst many of these enablers that are serving financial institutions is that changing out the core is really going to be a non-starter for most banks. And in turn, they're bringing capabilities to market that provide modern tooling for banks without altering that core. And we hear these referred to as sidecars, which are kind of like these auxiliary cores that might run parallel to the bank's existing infrastructure. And so I think this is very important because financial institutions on the whole are really museums of technology. It's not easy to pull out all of that legacy infrastructure and sort of change the engine while the plane is running. And so these fintechs are playing a very important role in helping banks digitally transform without requiring that full rip and replace that might be necessary otherwise.
Well, I think this is one of these fascinating areas in financial services technology in which you've got a set of players who are right out there on the bleeding edge in terms of what they're able to do, new payment methods, all these kind of capabilities. And at the far other end of the spectrum, you've got what are a lot of these core players, the banking business, that are having to grapple with much greater levels of change. And then in the middle, you've got all the trading houses in their various forms. It really is this quite a spectrum in terms of the kind of technologies that are out there. And I think more importantly, the pace at which any one of them is willing to change or actually has the ability to change.
That's right. And no shortage of headwinds facing financial institutions that are really creating this impetus for modernization. You pointed to the evolution of the regulatory landscape, certainly a wide spectrum of fraud and cyber threats that are facing financial institutions, from synthetic identity fraud to new account fraud, account takeovers. We talked about the pressures coming from the B2C fintechs that are potentially eating into financial institutions' deposits. There's macroeconomic and geopolitical uncertainty. There's all of this that banks are up against. But what we find really interesting is, at least in the U.S. market, this shift towards instant payments or real-time payments has created this inflection point. Yes, banks understand all of these other threats, but now there's a need to really change out their technology to keep pace with the evolution of the market. And we actually did see some evidence of this in a survey that we partnered with our FIG team within S&P Global on, where we saw amongst financial institutions in the U.S., about a third are considering deployment of either RTP or FedNow within the next year. So a meaningful percentage of financial institutions are thinking about what's required to change, and in turn, that's creating a lot of attention within the B2B segment of the fintech ecosystem around the opportunity for modernization and new infrastructure.
Moving things forward. Well, you mentioned geopolitical, and I think we were remiss if we didn't talk about it. And Sampath, you'd also talked about cross-border. That's an interesting environment in which we start thinking about some of the paths towards, again, reducing friction in some of these transactions. That's a place in which we've seen crypto creep back in.
True, very true. And crypto is back in a big way, and more specifically, stable coins, right? So, as a fintech research practice, we are not really interested in the speculative nature of crypto, but our focus is really what crypto can do, as a medium of exchange or as value storage, right? And that's where I think the payments industry has probably seen uh, you know one of the more consequential uh, developments in recent times. I would say the passing of Genius Act in the US is probably the most significant development in the traditional banking and payments landscape.
Yeah, I mean, we've now got a political policy, at least. If we don't have a regulatory framework, we're at least directionally starting to be more crypto positive, I guess.
Yeah, true, very true. So what it has essentially done is it has certainly brought more regulatory clarity to the crypto space. Again, essentially, I would say it has brought more clarity to the traditional payment space in terms of what they can do with stable coins, right? And it has essentially set the ground rules for who can issue stable coins, how to manage them, and it also sort of created a framework for how stablecoin issuers must be regulated or audited and things like that. And all of that is very essential. And to your initial point about how stable coins could potentially play a big role in cross-border payments, I think that's probably the low-hanging fruit. While everyone is talking while everyone in the US is talking about this new law, I would say it's actually the international markets that are probably going to see bigger impact, at least in the initial days, because of this law. Simply because what we are essentially talking is how stable coins could well become a new payment rail, or perhaps a more efficient payment rail to move money from developed markets to emerging markets with volatile economies, high inflation rates, erratic or volatile currencies, right? So where the challenge is the legacy payment rails are perhaps are not doing the adequate job, not efficient, or very expensive, or quite delayed in terms of moving money, right? And therefore, there is an evidential data suggesting that emerging markets are demanding this kind of instruments to for them to receive money instantly, right? So I think that's going to be the real kicker. That's going to be I would say the low hanging fruit.
Well, you make a really interesting point there, which is you use the word instant. I think one of the things that I've been hearing throughout the podcast is it's that transaction timing pressure, and if you have payment rails that just simply aren't sufficiently performant, the fact that you now have a vehicle that can potentially get you there with substantially faster transaction times, lower effort, lower potential cost, hopefully. That's got a huge amount of attractiveness.
Yeah, that's a great point. I think one very unique thing about stable coins, or for that matter, crypto, is that if you compare it to legacy payment rails, right? Like you take Swift or you take any of the payment rails out there, they're essentially messaging protocols, right? And crypto or stable coins are also messaging protocols, but the difference is that when it comes to stable coins, right? They're both the medium is the message, and vice versa, right? So meaning that in case of legacy payment rails, once the money is once the payment message is passed, you would still have to depend on banks and other financial intermediaries which are running on these legacy systems that we've previously talked about, right? We're dependent on them to update their systems, update their ledgers to sort of process the transaction, right? Whereas when it comes to stable coins, it's a global ledger, right? So meaning that the transaction gets cleared instantly, right? So that opens up a lot of opportunities, and the relevance is particularly more important uh, in in uh, in corridors, in cross-border payment corridors, which are currently underserved by existing payment rails. That's probably the key point there. So at least in the near term, I think the relevance is probably going to be much more evident in corridors where money is flowing from developed markets, the likes of the US, Europe, to emerging markets of Latin America, Africa, some Asian markets, right? I guess that's where we're probably going to see some momentum.
Well, and you make a very good point there also about the transparency, being able to now see what those transaction costs look like more directly, and not having to be at the whims of, whatever the denominated currencies are in which the transaction happens. Now you've got an intermediate medium where you can actually transact directly in the medium and not have to worry about, always have to worry about it, but at least you can have greater visibility into what that transaction is going to look like.
It's an important point, Eric, and I think when many financial institutions hear the word stablecoin, they often freeze up. They often tend to overcomplicate it. I think what's important is really what you're alluding to. It's treat stablecoins as a complementary rail alongside others that exist today, SWIFT, FedNow, RTP, et cetera, and really start those conversations within the bank around the use cases where it could make most sense, right? Where could programmable, always-on money movement solve pain points, as Sampath alluded to, really for commercial clients. So, that could be gig economy businesses, it could be regional exporters, property managers, fintechs, what have you. And again, to tie this back to the fintech ecosystem, partners are going to have a key role to play here. And it's very important for financial institutions today to begin to understand the vendor landscape. Who are the fintechs that can help with creating on and off ramps for stable coins, that can support with treasury management, that can address some of the emerging AML and KYC considerations around compliance. And what's important to remember is that there are fintechs that have been steeping in stable coins for the better part of a decade, that are very well versed in the technology, that have built infrastructure to support financial institutions in this journey. And what Genius does is begins to provide the construct, the guardrails to allow financial institutions to experiment and begin to embrace this technology for use cases where it makes the most sense.
Well, we're stepping into I was going to say a brave new world, but one to your point that there's certainly been a lot of work on, but at least now that there's a bit more definition and not really certainty, but at least an understanding about where those guardrails are, what the constructs are in which the market has to operate, and an interesting new potential for where this can all head.
That's very true, right? I think stable coins with Genius now in play are no longer this crypto sideshow. We've seen the regulatory clarity arriving, and I think this opens the doors to so much in the way of experimentation and really the possibility for stable coins to begin to cross that chasm into mainstream banking. So interesting times ahead, without a doubt.
Well, so much more to discuss, but unfortunately, we are at time for this episode. So many more questions, but I guess we'll have to save that for a future date. I want to thank you both for being on. This has been great.
Thanks so much for having us, Eric.
Thanks, Ed.
And that is it for this episode of Next in Tech. Thanks to our audience for staying with us, and thanks to our production team, including Sophie Carr, Feranmi Adeoshun, Kyra Smith, and Adam Kovalsky on the marketing and events teams. I hope you'll join us for our next episode, where we're going to be hearing from the information security team as they come back from the Black Hat and DEF CON conferences and get the latest from what they happen to have seen. I hope you'll join us then, because there is always something next in tech.